We will start where we left off in class. We were calculating the discount factor. So that is equal to 1 over 1 plus the weighted average cost of capital, which we currently have at 6.7%, to the power of t. Oh, sorry. To the power of t. Okay. Let's get this for all the ones. Okay, I should put dollar signs before the 30 because that's the weighted average cost of capital. We want that to be the same. Okay. So now we have the discount factor. So the cash flows are going to be discounted at this rate. So the discounted cash flows are equal to the estimated cash flows. This is using 2022 as the base year. This is after travel has bounced back. So that times 0.937246. So that's times the discount factor. So this is the discounted cash flows for each of the years. And then we also have the discounted cash flows based on the last 2 years of pre-pandemic years. So this is right before the pandemic, the previous 2 years, what the average cash flow was. So this is using 1942 and 2347, the average of that as the base cash flow, and then growing from there. So the discounted cash flow is equal to, again, the 2-year average pre-pandemic times the discount factor. I can tell that the numbers are quite inflated, and this is partly because of the very large growth rates that we have assumed for Southwest. So let's see what we get under these assumptions, and then we can make alterations to see the sensitivity of our estimation. This 594 number of shares, I got this from Bloomberg. So if you go back to Bloomberg Southwest equity and then FA and look up number of shares or number of shares outstanding, you'll find 594 for 2022, end of 2022. So that's where this number came from. Now for the firm valuation, this is equal to the sum of all the discounted cash flows that we have over here. So initially the intention was to go up to 20 years, but I see we have gone up to 30 years, so 31 years. So we'll see again what happens if we change the valuation using just 20 years of estimated cash flows. All right, so that's the total firm valuation. So the enterprise valuation, this is using 2022 cash flow as the base year and growing from that. You can also use the pre-pandemic cash flow, pre-pandemic years as the base and then growing from that, taking the sum of the discounted cash flows over the next 31 years. So that's the firm's value, what we estimate the enterprise value to be, depending on different base years as the starting point. Now to find the value for the stock, let me delete this because I want to work with you for the estimated stock value. We need the total debt, because once we know the total debt, we have the firm's value. If we deduct the total debt, what is left is total equity. That's our estimation of total equity, what belongs to the shareholders. So let's get the number for total debt, 9473. This is short-term debt plus long-term debt. So the estimated stock value, for this we need the estimated equity value. So this is using the firm. This is using firm value based on the 2022 year base year. So firm value minus total debt. This gives us the total valuation for equity, and then if we divide that by the number of shares, that gives us the value, estimated value for each share. So that comes to a whopping 2,478. That seems quite unreasonable of an estimate, especially given that Southwest has been trading in the 30s, so this does not seem reasonable. So let's see how sensitive this is to our base year estimation. So instead of using 2022 as the base year, had we used the pre-pandemic cash flow as the base, how our valuation would have changed. Well, even then we can see it's quite large, like at 1716, and that's again partly due to this very large growth rates that we have used, even expecting like the 6% and then growing at a rate of 60% and declining by 10% each year. I think that's a very optimistic view of Southwest's performance. And our cost of capital is also quite low of 6.7 given how volatile Southwest has been lately. I'm not sure this is reflecting very well how much, like it's not reflecting the risk very well. So one suggestion that was made in class was instead of using, so here the cost of capital is estimated using this average of what seemed more reasonable cost of equity, using the average of that. So instead of using the 9.3% as the cost of equity, let's see what happens if we change the cost of equity to the 61.9%, which reflects maybe the risk investors are undertaking by investing in Southwest. So if we take the 61.9%, our cost of equity has now, cost of capital has changed from 6.7% to 34.6%. Okay, so to all the way to 34.6%. And let's look at the valuation. The valuation has changed from 1700 to 84.69. Right? So you can see how dramatically that one assumption has changed our valuation. Next, we have for our discounted cash flows, we went all the way up till 30 years. What would the estimation have been if we used 20 years of data? So here, instead of taking the sum over 30 years, if we take the sum over 20 years of data, 20 years of estimated cash flow, how would the valuation change? So this is the change I made was for discounted cash flow using 2022 as the base year, and this is for the discounted cash flow using 2019 and 2018 as the base year. So you can see the valuation changed again a little bit by 82.5. Right, so now we're using 20 years of data. We have discounted quite heavily too. If we go back and change our cost of equity, you can see how this might impact that. So one other thing what we're going to do, let's use the same 9.3, but here let's take a more conservative view of how Southwest is expected to grow. Right, so even if we use the 6.7% but alter the growth rates now, so instead of saying that it's going to grow at 59.78%, if we say that it's going to grow at a rate of 10% in year one, and then this growth rate will slowly decline. This will decline by 1% every year, right, till it reaches a perpetual growth rate of 3%. So taking again a more a more conservative view of how we think Southwest is going to grow. Minus 1%, so it'll grow by 9%, 7%, and then from this onwards it would be, say, 7% minus 1%. How it would change, right? The file that you have on Blackboard does not reflect these growth changes, so just bear that in mind when you're downloading the completed file. Okay, so 10%, and then from here onwards it's equal to this 10% minus 1% till it reaches 3%. Okay, and then the perpetual growth rate is 3%. So let's see how our valuation has changed now. Right, so even with a reasonable of like 6.7%, we can see that the stock price is now evaluated at 61.1, selling close to $32, so it might be considered undervalued based on this analysis. So now in this exercise, it's illustrated how sensitive valuations are based on what assumptions you're making. Slight adjustments in your assumptions can have a drastic change in your estimated value. So when you are making these decisions, you need to sort of have some evidence to support why you are doing what you're doing, but at the same time, you have justification, and you're using your best intuition to come to these estimates. So hopefully you'll be able to apply these to your stock, and you get to learn from this. Best of luck.